Hey guys, All in Crypto here, and welcome back, ladies and gentlemen, for another YouTube video. Today we have the man, the myth, and the legend, Mr. Francis Hunt, coming back on the show to talk to us in what is an interesting time for the markets. Welcome back on, Francis.
Delighted to be back with you.
Yeah, it's an absolute pleasure. And I think last time we spoke, the Fed were really turning the screws in regards to tightening. We hadn't had the fall of Silicon Valley Bank, which I think was the second largest bank in terms of assets in the US to go kaput. And then, of course, we've had the likes of First Republic, the 14th largest bank, and a number of others that seem to have really caused a bit of a shift in regards to the macro landscape. And we've certainly seen risk become the flavor, the dollar get weakened by this, and a number of other things. So could we maybe start by getting a bit of an overview on how you see the macro landscape at the moment? Is risk the flavor of the month? Is the dollar likely to continue to get weakened? You know, maybe just help us navigate that a little bit.
When you say risk, there's different categories that are fragmenting out as well. So for very high PE tech equities type risk, you're going to probably get a degree of risk on feel again, and you may get a short rally. That, I think, is going to be very short-lived and dangerous. In fact, when we have a look at the two-year debt markets and explain why it's important, it'll come out there. So you're going to get a little bit of risk on sniffings. I think that's very much a bear trap. So it's bringing a little bit of bullishness back into it. However, outside of that, you have what I would describe as the anti-fiats. And the anti-fiat gold and also, of course, Bitcoin and crypto more broadly. I think there's more scope. And I also think it's not a surprise, funny enough, that Gainsler has gone for Binance, and all of these things are happening right now as banks are failing. Don't forget those banks were on-ramp and off-ramp banks involved in crypto. We had Silvergate, I think it was, SVB. Those were we effectively had the second and third largest bank failures after Lehman's. All bailed in, very quickly done. And then you have the situation that they're actually backing the big banks to the detriment of the smaller banks, that has seen a transfer of deposits into the bigger banks, which is going to be so much easier for their CBDC release and all of that. They're herding the sheep into the abattoir. And Yellen, of course, was picked out about that in between her prognostications on climate change being an existential threat, which is an ironic comment for people that are supposedly central bankers. But I have a risk of spreading into too many topics here. So overall, there's going to be this lull period that's going to get bid up slightly. A smart man would ignore this and prepare for the slam. In short, it's my personal opinion that we have passed now the safe period for risk on, certainly in terms of tech stocks and general equities. That wouldn't be the same for, say, a gold miner, et cetera, et cetera. But we have passed the opportunity that you should be in that. This is your lull period before it's kind of eye of the storm, where you should be really making sure any last hatches that haven't been battened down are battened down. And it sounds like a perpetual doomsday speech, but it's not. There's real opportunity for the anti-fiat, and I expect gold to go up a whole bunch further. We've done a video and we spoke internally in the community, which you'll know about, in excess of 100 Rs for that potentially. We see a run towards 3,000 through the 2,900s on gold. And that's got to be good for Bitcoin too, to a degree, in spite of the current FUD and activity against Binance, because they are anti-fiat. So when we talk risk on, risk off, equities, gold and Bitcoin could have easily all been lumped into the same bag. Now we're going to talk a demand destroying event, which pretty much I'm sure is going to be banking. So the holy trinity of the satanic system is, in fact, debt. Money is borrowed into existence, so it's debt markets. You've seen the problems with the British pensions markets. You've seen the lack of bid in the Japanese. The alter ego of debt is the currency that is borrowed into existence. Gold exists without a liability. Money, currency that is borrowed into existence, exists with a T diagram accounting with a liability. Your asset is somebody else's liability. It's borrowed into existence. And of course, the intermediaries that proliferate these debt instruments of currency, the banking system. So this is a crisis of that trinity, in essence. So you've seen banks fails, you've seen a lack of bid in the debt markets in various nation states. And by the way, you're seeing China tapering their treasury holdings at the same time as gold is getting bid up. You saw the central banks stocking up on gold like they haven't been buying before since the 60s. So what you're actually seeing is people dumping garbage paper, which is a lot of it dollar denominated, and preparing for the fact that the dollar will no longer be numero uno, the de facto Triffin's dilemma privilege currency of world trade. And of course, you're seeing Russia accepting yuan and et cetera, et cetera. So the ongoing unraveling of this monopolar currency system is well in play. And it's going to get associated with bank failures and many other things. You had the Americans have had to suffer the indignity of the Kenyan president talking about the unsustainability, and trust me, in a matter of weeks, the dollar goes. You should be out of fiat in American banks to just a subsistence level for your existence. You should have that money in things that you can hold, not even vaulted, money that you can hold. And of course, Bitcoin can be part of that as well, out of exchanges, because they're going to try to take down banks and centralize the exchanges as much as they can. They may even try to take down blockchain as well. So right now, the really safest thing is you own what you can hold. Yeah. But I would argue cold storage Bitcoin is probably a lot better than dollars in a bank account right now. A, for appreciation, and B, from a point of view of being sold a Russian hack narrative or any other nonsense that they could perpetuate against you. That's where we are. So in terms of how you position, we've had what we call a slap in the face on the debt markets. I think the 2 years had its peak highest point, and the 1 years, the short-term debt, they hit their peak. This crisis was the slap in the face, and it's the warning. And what tends to happen is you get weak rallies and attempts to make the previous high. So, I mean, if I just share a screen and we just take the US debt markets into consideration right now.
Isn't it interesting how I saw something earlier and it said it took the US, I think, 215 years to add $7 trillion worth of debt. And they did the same thing in 2 years. This is happening at the same time where we're seeing a real global shift away from the dollar, whether it be the BRICS, whether it be South America. We also saw last year, I think it was record amounts of gold being bought by central banks. There is a lot going on right now. And I'm of the thinking, and I'd love your opinion on this. You know, something's coming down the line, right? The yield curve's predicting this. It's likely going to be something pretty nasty. We know that a pivot is typically also very bad. Have we kind of got like a window of opportunity here, do you think? What's
it's
your
last gasp opportunity to get out of fiat and banking system? This is your last gasp opportunity. So this we call the slap in the face. It's an extremely strong, you know, bull moves end off in exhaustion. You had a preemptive move that was minor bullish, and then you get a little bit of a push. This is called the marginally higher high principle. You had a very chill pullback here. This fell into the category of falling wedge almost. You can draw the wedge a number of ways. You could draw a wedge there. You could also draw it like that. And that sets up your next move higher. The problem with this move higher is it only went marginally higher, technically ran the 5%. So we are looking at the government bonds 2-year yield. And that is violent, and it took out previous lows. And what typically happens is, and you're bouncing, ironically, on legacy targets that were sitting here. So key levels of significance, that'll mean something to you who's done our basic content, but Absolutely. You're actually just churning here. And what I suspect happens is everyone's going to say, you're wrong, rates are going back up, they're going to do this, and then they'll come down again, and then there'll be another period. So you're in a window period where I think this happens, and then you end up with the demand destroying event not being too far away. This isn't to timeline scale, but then you get that. Now, by the way, although I'm calling a sell-off, a reduction in yields that actually typically normally is associated with positive bond valuations, it's going to be associated not nearly as low. It's not going to go as far at all because people's confidence in debt has been greatly undermined. So it's going to be a pullback to a certain level, but we are in a macro tightening yield cycle. But this demand destroying event won't get you right down to where you were in the CV19, because the confidence in debt is gone. And in actual fact, you've already begun to see the pivot into the precious metals. And I think Bitcoin is also part of that. So there is a big difference, which is why I pointed out you can't be a risk on, risk off guy. The overvalued equities could be tanking, but Bitcoin and gold could be going up. This is about the alternative money in hyper overvalued items that need to contract as asset classes. You're seeing subprime cars unraveling. People can't get finance anymore that used to be able to. Dealers on new cars are discounting. You're seeing, I've just bought a new car. They offered off the floor straight away, a few thousands out of the gates.
Wow.
And
that's unusual for car
well-established
salesmen.
brand.
Yeah.
Yes, that's right. Straight up, it's not even like ask for a discount. Well, but we'll be doing this straight away. And that's because of competition from used cars, a lot of stock sitting long. They are already feeling the stall. For those that like associated thinking, this feels like mid-year 2007. This is stall. You're still technically carrying on like it's going on, but the party's running out of fizz. It's like the drink is running out, the drugs, the cocaine and the heroin dealers are slowly disappearing. There's scraps lying around. There's a lot of people kind of wasted, carrying on, but there's still little bits and bobs eking out, and people are still thinking it's all good to go. And the cops are just about arrived. You should have left. And this is the detox that you're going to get, the real hammer that's going to come down. And this is why I say this is still to happen this year. And as I said, this is not to timeline, but I would expect that. And that's going to be associated with a far bigger fall on overvalued assets. So the interest rates, this is the concept of hyperstagflation. The interest rates will never get too low again, because you aren't going to get a bid under the debt. When the interest rates go down, that means bond appreciation. You'll get a few people who will take that trade, but you're not going to get a massive bid in the debt anymore, because people aren't buyers in the US debt system anymore. And the same way, you can't turn away from the dollar and not turn away from the debt that's borrowed it into existence at the same time. This is, it's alter ego. They go together. It's my shadow. I can't ever exist without my shadow following me. Wherever there's light, there's a shadow. And in essence, so you get a small spell of bid up in the debt, but a much bigger collapse in assets like equities. And I'm talking about the traditional ones that have benefited from the bull market since the Volcker years as Fed chairman. So Greenspan, Bernanke, Yellen, Powell, the entire era of all of these clowns, or I should say collaborators and manipulators, that is going to be the coming home. So if you ask me, I would not be a chaser into most equities. Obviously, it's different by industry sector if you're talking about gold mining, silver mining. But I don't even want to say other commodities, because many people will say, but it's going to be good for other commodities, surely. And actually, no, it's only going to be good for real money alternatives. And that's Bitcoin and gold for me. And of course, silver I include in that. And you can argue platinum as well. But in fact, the ones that are highly industrial, I'm not super bullish palladium right now. It's entirely an industrial play. It's hyper overvalued relative. In fact, we've given trade short. So it doesn't mean good oil. And in fact, if we go to the oil charts, and I will show you something that I've recently released, but I can also give you a quick heads up on. We're actually downside on the oil. And this is associated with the demand destroying events. We had it also in the events of March 2020. And that was more than just financial. There were lockdowns involved and loss of freedom of movement, et cetera, et cetera, et cetera. And so here we go.
Do you think that this downside for oil is going to tie in and potentially be what the yield curve is predicting? Do you think this all kind of rounds up? We see this dropping in the 2-year. There could be but then the interesting thing with that is, do you see the Fed pivoting on that catastrophe? Because you spoke about this kind of hyper stagflation. Does that not involve having higher rates?
They've pivoted. I feel this is the last increase. Maybe they could do one other quarter point if they're limping on. But I actually think they're acting tough and saying, no, we still got to worry about inflation. They're standing the pitch. If they weren't so bold about these banking issues, if they'd not done a quarter point, they would have made everyone believe, wow, it's worse than we thought.
They didn't have a choice.
They had to maintain some element of course. But the truth of the matter is the damage wasn't done in the most recent quarter point increase. It's done in the first one, and the 0.75s that follow, and the lag effect that those are taking to bite. So they were late to arrive, and they will overshoot. So they probably didn't need this quarter point, but they had to do it because they didn't want to look like they were being super reactional. But what they did say is they're being more data dependent now. So that means whilst we committed to a tightening cycle, now we're no longer saying we're committing to a tightening cycle. We're going to see how the world is responding, and we're going to take the temperature near term and make our decisions based on the feedback we're getting there. So that is a pivot in of itself, because it was no longer, harder, longer, harder, longer, harder. Whoops, now data dependent. That's a pivot. And that's what's giving the bid to the equity markets in essence. That's a soft verbal pivot that might belie the fact that things aren't great. They're now realizing it. They have successfully broken something, and we're in a stage of collapse, various stages of collapse. So this was the head and shoulder that we drew for the oil in Dixie. That's in non-dollar terms. So that's the dollar index. And this points to an immense loss of value. The dollar index is 103s, 104s, 105s. So it's like dividing by 100. But this coincided with $74-ish oil. And when we went, we were saying shorter was in the upper 70s. You've had a little bit of a rally back. So everybody will come and say, you're wrong. You said that and you're wrong. No, we haven't had the capitulation phase. This is your window where you get soft rallies against the bear call that you should actually be loading up on your shorts or holding on to your existing shorts, and everyone else should be scurrying for cover, because the next leg for me is down. And you run that inverted HVF's targets, and I expect that head and shoulders targets also to be made, which would take you to 0.38, which is probably going to imply $35 to $40 oil, depending what the Dixie does against the dollar. And the dollar is softening. There was a possibility. Was there a Euro USD head and shoulder? No, not for me. It's clearly not going to go into reversal. The irony is you may get an alternative to the dollar like the Euro actually getting a bid. And this dovetails with our Euro Polish Zloty trade and all of these things that we are expecting to come onto the burner at some point. But they don't happen to the absolute day and second. These are macro calls. The dollar capitulation event, where you get real movement and it's grabbing the headlines, could be 3 months away. It could, don't come back in 3 days, come back in 3 months and tell me where the dollar price. So this for us is a bear its case, and this is just a small triggering and a return move so far. So we're wrong. What's our level of wrong? If you get back above that 0.78, what's our level of right? 0.38. And you start to have already got your first pattern right at 0.59. This is all in play, and things don't go down in straight lines. And then suddenly you have a capitulation phase. Boom, boom, boom. And that's a lot happens suddenly. So we're in that stall. The opening shots were fired, and then there was quiet, and everybody wondered and looked around and is loading up the real men and calling in the artillery. Now the war will kick off, and there's a window, and that's kind of where we are. And that's what I'm seeing on the interest rates. On the bond market, it's what I'm seeing here. And it's also what I'm seeing on Bitcoin, because for many of your audiences that are particularly crypto interested, we said to everybody, Bitcoin is a reversal, but you will stall at the 47.5 on Bitcoin dominance, because it's been a key level of significance of stall many times before. So let me just try get that chart nicely set up for you. And here you are. Here you are. There it is. And you can see that this has been a regular range play. You absolutely ripped out of our flag, as we suggested you would. There it goes. That was the trigger. And you absolutely ripped it. And where have you now made non-stop? 1, 2, 3, 4, 5 in a row, all sitting at the 47.5, that blue line. which dovetails with the reaction there, the reaction there, the reaction there, the reaction there, and the reaction there. That is a dominance query. Now, you could get a pullback there, and the alts could start coming on the second leg, and Bitcoin comes back down. Or you could just get Bitcoin dominance continue to move up, and the next point where it runs into heavy traffic would be somewhere up here. That's well through 50%, 50.7. I can't tell you which direction right now the dominance would go. Out of that, it's a little bit uncertain as a technical pattern. It's resting at this level. But my overall opinion is it could go up, it could go up, it could go down, but it's going to do one of the two, obviously, but it's churning for a while during this period. So this is part of the lull. It's part of the lull that's happening. And it is, I would guess, Bitcoin continues to build on some dominance and actually breaks this overall period here. This has not been a downside continuation pattern generally. So if we look at this technically, it's not what I would call a downside. It has more of a slight bottoming feel to it, which will make the maxis quite happy in that sense. So it has a little bit more of a bottoming feel. So I'd certainly think you'd get some probe. At some point, it may slow down and churn and mess around, and then we have broader participation. But I think Bitcoin starts here. When we look at the gold, and this is, I encourage crypto people and maxis in Bitcoin to view gold as a friend, not as a foe. This is an anti-fiat category. What's good for gold will be good for Bitcoin. Have a stable of horses, as I've said many times before. During Raul's period where he was irresponsibly long, I think it was Ethereum. I've always suggested, have a stable over just the one. And if I turn the lights out just to take all the lines, we've done a lot of work on this chart there. There we go. Whoops, double click. This guy on a weekly is a big continuation pattern, but it is also in a temporary moment of reprieve, just like where Bitcoin is on that. This is your bull pole. There is your flag. And this is currently broken and having a technical rest. That is a trigger. And Bitcoin has triggered its, we didn't go Bitcoin dollar, we went Bitcoin dominance, but Bitcoin triggered its key level and has run up to 27.5, and it's turned into a churn point. And we had localized target levels. I'll go there and I'll show you. So now it's a question of what's going to happen on the smaller time frames in here. And we actually think it's good news, as we mentioned inside the community with updates that you might have had the time to see if you were not too busy. And that is that there is actually something brewing here.
Yep. Isn't it interesting how gold and Bitcoin are kind of married up right now? They're both at these key levels, taking a breather, but both looking for more upside. And I think this ties in with what we've sort of spoke about at the start is, there's going to be this period. I don't think Bitcoin and gold escape the demand destructive event. They might recover a lot quicker from it. But my sort of thinking with this window of opportunity, not necessarily for fiat and equities, more so for Bitcoin and gold, is they're going to maybe have this window where they're going to run. Could be the next 3-6 months before this takes place. You're kind of playing chicken a little bit, I think. But at the same time, I don't think you're going to necessarily, or perhaps you're not going to see new lows for these, even with the demand destructive event. Very hard to call that, though, I think.
Well, if you just look at gold, it was bad. Let's be frank, it was bad for Bitcoin, the March 2020 events. You ran 4,000. In some cases, you trade 3 nines, whatever. It was bad. Gold shrugged it off quite well, but it also had a dip. So if you were asking me, how do you position the demand destroying event, previous demand destroying events that went with March 2020 as one example of many, gold actually did better and it came back super strong. It will be seen as a buying opportunity, and a lot of people will be marking those futures contracts for delivery. So the paper price in America will start to become less and less meaningful if COMEX can't deliver. And they're just doing cash settlement. In other words, people will revert to what's the Shanghai price, and when the Russian exchange starts, some people already reporting that people are paying 5,000, the equivalent of $5,000 for a single ounce of gold in Russia on the black market. So, I mean, whose price discovery is more honest? Well, a black market is a black market, but if you've got dollars to get rid of, it might be hot money, it might be untaxed money, it might be, you know, money launderers' money. The point of the matter is I don't trust the COMEX price discovery mechanism. So, you know, if I've got money to get rid of, then I maybe would pay $5,000 an ounce, the equivalent of, just to get rid of those dollars. So there's people getting rid of dollars. Now, this could break down. I don't only want to say that this is definitely up. I mean, we could break down here and run this bagel, and then we get pushed back a little bit. It's not our big event right now. Bear in mind, I'm on a 1 hour chart. I consider this very small time frame. So you'd just be dipping back in. But when I turn the lights back on of all my lines and research there, you'll see that that big thick red line there, that is the top of the flag on the bigger time frame. So, you know, maybe you dip down there and you kiss it one more time and then we go up. Or maybe you dip back into the flag for a while, somewhere deeper down, and then we come back a second time. You don't always get it when you want it, when you're looking at the small time frames. I wouldn't want to see us run this level. I will close any leverage longs that I was using to trade this on the break of that. And I'd start to be concerned on the break of that. But if this breaks to the upside, this is well over going to 2,900. This entry right here, if I just show you the risk reward, it's 140 RRR.
Wow.
So if this doesn't break, you know, you risk $1,000, you make 140 grand.
Yeah.
To 2,905 for gold though. And that'll probably take, it took it a year and 1 month, 13 months to make the up pole from the lows to the July 20 highs. So just let's show you gold, because I do think for crypto guys, gold was a good example of something. When it's in a bull market, that was your entire COVID events, gold. And it started its run there. You know, so you had that pullback. You had all the events of COVID pullback that it shrugged off, made a bull flag and went higher. So providing you in an investment mindset, that was small beer. We have to show against Bitcoin that was far more destructive. And most will remember that. And that was, you know, we literally spilled, and then there was a liquidation, a largely liquidation event. Only hodlers stayed.
It was a brutal one. I think it's worth stressing, whilst we're on this point, that everyone out there, and you don't need to take this as financial advice, but take this as friendly advice, needs something outside of the system. Because we could literally be looking at, you know, this might only happen once in our lifetimes. We don't quite know that. But an entire monetary regime change. It very much seems like things are coming to an end for the dollar. Might be interesting to find out maybe how the dollar milkshake theory plays in all this, which is interesting. I'm kind of trying to figure that out myself. You know, how do they bolster their currency? The only way it seems logical they can do that at this point is to weaken everyone else's. But everybody needs something outside of the fiat systems that they're in, whether that be gold, Bitcoin. It could be even, you know, bottles of alcohol or something like that, because when the shit hits the fan, it will hit the fan, and we're in the sort of we're on the runway to that now, I believe.
Yes. And as I'm saying, this is the stall. You've had the SVB, the Silvergate. This is the in-between stall before the next rolling aspect of this crisis. And that was your capitulation on Bitcoin, by the way. So you were around 10 and a half down to 4. But providing you were patient enough, you got back to the 9s, 9.5s, most of it within, this is weeks, 1, 2, 3, 4, 5, 6, 7, 8, 9. Within about 13 weeks, you were back up. But that was quite lengthy. Gold was back up a lot quicker and didn't fall as far. So it was a little bit less gut wrenching, but it won't go as far either in a leverage situation. Bitcoin has a higher beta, so it will go higher. So yeah, that was something just to bear in mind. And you are higher today than that dip on both those assets. But a 50% on gold is a very, very big move for gold. And going from 1900 to 2900 is huge. And that's also not the end of the story, by the way. I would expect a pause then, and then further upside. My biggest concern is how they're going to try to take our gold off us. Well, if it's vaulted and you're not keeping it at home, home can be buried in a hole in the ground, midnight gardening, whatever. You could be robbed from. Just on the rates, because you asked about yield curve inversion, I'll just pivot slightly. We go back to that 10-year and also the 30-year, US 30-year yields. So the yield curve inversion is 100% indicator, essentially, in our worldview.
Do you know, and just before you go on there, and I've often thought this myself, right? And you know, I've not been doing this game anywhere near as long as you have, but I have noticed with these 100% indicators, there's always a first time, right? So there's always a first time it doesn't play out. What are your thoughts on that? I mean, it seems kind of unlikely. If you're a betting man, you don't go against that. But I always think to myself, you know, and when was the last time that the yield curve had to be in this kind of an environment? And is there a chance that there's some sort of a different path that it takes in regards to the market as a result of that? What do you think about that? Do you think there's always, you know, there could be a time where it doesn't play out? What's your...
So structural stress in the debt markets is structural stress in the currency monetary system. Those three things are almost largely interchangeable. They mean different things, but it's a bit like saying, well, if I take one, you have one of these homes with 4 pillars in the marsh. If I take one of these out, it doesn't matter that one has one name. It's the same as if it was the same stress on another pillar. Your whole house wobbles. So the whole house wobbles on these major pillars. And my assessment is the yield curve is one of the few points of truth in actual fact, because what people do and not what they say is reflected in that. And a concern about debt and debt system is being reflected in the yield. So people are deeply concerned on, and they don't want to hold the short term particularly. They're deeply concerned about the macroeconomic direction. And that's the big money. That is the big money. And it's generally been a very good system. So I would suggest that this was, like we just said, actually, the 30-year found its high here. And I don't know if you recall the 2-year that we just had before, but the 2-year had a high here. It was here. It was a marginally higher high. Do you remember that? I might have to split the screen if you don't recall. But essentially, the 30-year topped out in October on yield. So the 30-year, the bigger bond, was earlier warning, and now the shorter yield, the 2-year, made a marginally higher high, which you recall, and then spat down. It spat down on this period here, but it was up actually over here. So all the time that you were getting this yield is going up on the short term. The short term is like the child, if you want to think of it. This is the old wise horse. The yield version was deepening because the short term continued to go higher. It did this. It came down here. Whoops. It came down here and then made a marginally higher high before getting slapped during this period. The 30-year was not interested and didn't run. And that proves the old horse knows best. And if you take the 2-year away from that now, minus US 02 yield.
This is why it's so important to look at these things, because you essentially had a lead indicator in the 30-year yield. The 2-year yield really got slapped on the BV news, right? The Silicon Valley Bank. Whereas the 30-year was saying, well, we already knew about that. You know, you're kind of late to the party without the event actually taking place. Technical analysis and markets are, you become like an insider, I think, when you really start to figure out how to use them. There's a lot more to using markets than just looking at a chart. I think using them in conjunction is a big part of it.
You see this huge reversal candle.
Yep.
And as I've highlighted before, the harder you smash into a yield curve inversion, the harder and faster you come out. V in, V out. Rounded in, rounded out. And there was a smaller dip. But your first inversion, it's a leading indicator. 2006, January 2000, you went into recession 01, 02 there, and you went into serious depression 07, 08, which is here. Here's where the drama strikes. So getting back above the zero line is when you start to have the problem. It's hitting you. You'll get your Lehman name. You will get your name for your crisis coming shortly once that has occurred. This is the setup for the crisis for which you inverted in 2022 quite early. So we've been living in yield curve inversion land, knowing something big is coming, waiting for the actual label and the drama of that to be given a name in the subsequent event that follows, returning back above the zero line. And that's even better illustrated if I do it with the 10-year instead of the 30-year, because I've done quite a lot of work on the yield curve here. And you'll see there's annotations for that one as well. And I've annotated this exact event very clearly. And this is the monthly sign, monthly chart for the yield curve inversions. And you can see all your crises when they happen, when you get the yield curve inversion, and then when you get the name for the crisis and all the problems. So, I mean, for most people, a bit of a younger audience, I'll spare them the 90s stuff, but .com, here you were 1st of March, and in December 99, the problem was 01, the back end of 01, 02. Here's the inversion in 2005, December into January 2006, 7 and 8. 8 was Lehman, 7 was the stall speed, where you are starting to come back out. Here you touch down with an inversion, the repo liquidity that was August 19, you got your crisis actually above the yield curve, CV19, the events of March 2020 that must not be named, that occurred there. So your inversion actually probably, you just didn't invert there, but that was probably close to your low, 3rd of December 18, and then you just dipped through with a final capitulation. You just dipped through zero. So you got a very small inversion. And that was the precursor to the financial issues that brought March 2020. But you can see the red box follows the orange box. The name for the event, you get the name. So we had one of the deepest in modern era. You have to go prior to all these 90s crises, the deepest yield curve inversion you've ever had since Volcker era. So all the 90s, let's safely say the last 35 years. And now you've started that very abrupt, highly volatile reversal movement. And that was the fact that the 2-year continued making a marginally higher high when the 30 years didn't. So you were taking the 2-year from the 30 and you dipped deeper. Now the 2 years been spanked back down and is falling more in line with the 30-year. That difference is not going to be as acute, and you've started to come back up. Yes, you have been fizzled a little bit on this wick during this period, but it is the beginning of what I expect to be the reversal. By the time we're running through the zero line, it will be mad panics. If you're not on bare bones fiat in the banks and on maximum cold wallet Bitcoin and physically held gold, you are about to lose most else.
Yeah.
And if you've got purchases like solar panels for your repo farm, your reset farm, I mean, and things like that, purchases to make them now.
Yeah. Yeah. This is it. And looking for that uninversion, that's a huge warning, right? You know, this is what I mean by, and I'd love your take on this, and we've covered it. Somebody like myself, perhaps, that's sort of spot long crypto and has been since the start of the year. What would you say to someone like me that's probably quite heavy in the crypto space from a spot long point of view? Would you say don't play around in the road for too long? What would you? Because I think there's a danger to not having a position as well as a safety. What would you kind of say to someone like me that's spot long crypto right now?
Diversify. Diversify your funding into things that you control. So the key thing about crypto is it is essentially a digital asset. That means convenience. You can post me money much easier than it is to post me a gold coin or a bar or anything like that. But what we're seeing is digital is also utter surveillance and grid reliance. And if you're on a tax system somewhere in the UK, for example, and they see you sending Bitcoin, they can demand immediately you explain what it is and submit a capital gains tax return, and et cetera, et cetera. So you're utterly surveilled. You can be extracted against on blockchain, and they can have bots doing this. They can have AIs for it. Remember, if the end goal is a Bolshevik communism with everyone on UBI, where they ultimately completely control you, you rely on them for your money, your food, your everything, and you are not self-reliant, and that is my assessment, they will use the technology against you. They will surveil you and tax you out of it, reduce your wealth through taxation, extraction, harassment. And the fact that you can't hold something that I would want off you, and you could pay me certainly for services in the form of physical gold, means you are under-equipped for a grid outage, you're under-equipped for telephony, digital mobile services outages, or complete surveillance. And you know, they can do 15-minute cities on the internet and on the digital system in the same way they're trying to do so physically. Far easier digitally to do. But they want to herd you all into the digital. So they're doing it first physical, where it takes much more time and preparation. It's much harder to do where I'm sitting 15-minute cities. Good luck in a part of the jungle and the highways of Panama and all of this, trying to lock people into a certain amount of space. So they're probably not even trying in any meaningful way. In the UK, where everyone's compliant, law-abiding, has homes, their homes is their castle, and has to go to work, you can mess people around. You can't come down this road anymore. This is beyond your zone, whatever, whatever. So they're going to come at you physically and digitally. Digitally is far easier. You will get freedom for longer in the physical. So if you are totally digitally positioned, you're positioned for one outcome, you're not positioned for other outcomes. What you need is a Swiss Army knife if you're marooned in the jungle. It's not great. You'd prefer a saw to cut wood, but you'd also have a magnifying glass to start a fire. You'll have a screwdriver to unscrew, you know, a piece of metal that you find, to have pieces of metal that you can make a tarpaulin shelter. You want a Swiss Army knife. You need a couple of tools. And this goes, again, back to a stable over the fastest horse. I don't doubt that in appreciation terms, there is a good chance that if the dollar system and the debt system goes down, that Bitcoin and or other cryptos could be the highest appreciator, the fastest horse. But I don't want all the other blarney that'll go with that in the digital realm without having something in something else that can't be switched off through power, that I can meet you face to face and give you a gold coin, and you can give me 3 laying chickens, hens, for eggs. That's, no, I want that.
I totally agree with that. You're making a big bet to be all in on any one thing. Certainly something that's digital that you can't defend yourself, you know. From maybe more of like a trade point of view with being spot long crypto now, how would you play that? Would you just sort of look at targets? I know you've got targets for Bitcoin.
The bias is long. This is a long. The good news for everybody, and there'll be some people that are hating on me because I'm talking about gold as well in all of this, but the good news is they're friends, and this is a long.
Yep. So
I've got good news for you. That is a mofo of a candle on the monthly charts. Whenever you have any doubts about a market, go and look on the big time frames and do just basic candlestick analysis. You don't have, I don't have books on candlestick analysis, but there's a guy called Neeson who does, and I read his books many years ago, and you can go read them.
Yeah, I've got the book. I think it was on your book list.
Yeah. And I mean, that is an attempt to go down, and that was your right shoulder, but that is your dip one way, go the other way. Now, we do a specific piece of course content on this very candle, the look one way, go the other way candle.
Yep.
And it is one of the strongest candles you have, because it's a flush out to the downside, an absolute smack back to where it came from, and then a further long jump in the opposite direction. That is the final flush. And that was right shoulder, inverted head and shoulder as well. On a lower time frame, you'll see that detail. But just standard candlestick analysis says the only thing you should be thinking about is long. But that doesn't mean you don't get pauses and down legs on smaller time frames where everybody loses the faith, because everybody is instant gratification, doesn't understand. You will fail to the time frame that you keep being nervous about. If you want to be a macro time trader, you have to look at the monthly chart and say, is there anything to worry about on this monthly chart? Answer is no. But that doesn't mean it can't go to 27.5 again, or even 26.9, and then rally back up before the month is over and still be fine. But if you're going to bedwet and tick watch, you're going to flush yourself out. So the key thing is, if you're doing that, you're oversized, you're over leveraged. If your first thing you're having to do in the morning is have a device by your bed with the 5G frying your brain while you sleep, and you have to pick it up and look at it to know what kind of a day you're going to have, the joy in your day is determined about whether the Bitcoin is slightly more up than what it closed when you finally dragged yourself to bed from big eyes watching all the screens on Bitcoin. You are too big, you're too engaged, you need to come back out. No one makes good quality decisions when in that state. The big chart is telling you, this is awesome. This right here is awesome. That's a great candle. It's not a good candle. It's a great candle.
I always say to people, their position's too big if their other half's asking them about it.
Exactly. So that's the monthly chart. That is a great candle for Bitcoin. So rejoice. I've given you some good news. If I take it down to the weekly, you have just paused for a bit now, and we've highlighted the Bitcoin dominance level as a key structural area where we expected it to pause. We said the 47.5. We gave you that before it happened. And look how quickly you got there. When you ran, you ran. And we had the likes of Peter Brunn saying that's a broadening structure. They didn't know what to make of it. They didn't know if it was bullish or bearish. It's a bit like saying that's a dog. Is it a friendly dog? Do I eat it? Is it a pal? What is it? You've got to decide what to do with it. This is a continuation structure, and there's real theory for it, and we have real theory for it. And that's what I was trying to highlight. It continues to be a long, but you've got to recognize in that right shoulder dip here, you absolutely spat out, and you just don't go up in straight lines. You've just run a key level of 27.5. Never mind the fact that we said 25K was a triggering event. You should have been long already then. I think that's a little higher than I've drawn it, somewhere up there, or maybe here. Get it right one of these days. There you go, the higher one. That was your neckline. And never mind the fact we told you before it went down that we expected to go down, and that the two key levels that we've showed on our own crypto channel that are likely to be run are the legacy high of 19.8 and the round number of 20K that ran straight through here, that you literally just ran. And that is key levels of significance, HVF method, technical analysis. So you've got to trade. If you want to look at monthly charts and weekly charts, you've got to trade like a weekly trader. That is not someone who is getting in and out very often at all. He's made a macro assessment and you're net long. But this could dip and visit 26 and then set up a wind up and then smash it back up. But for me overall, it's bullish. I don't think it necessarily does that, but it could. And a lot of people will be scared or nervous. You could even get a neckline revisit. It's gone a bit far for me to do that. I don't think it's super probable, but a lot of people will be shaken out on it. But it's still an amazing monthly candle. Broadly, this goes up. But you've got to look at it now. What is it doing on a lower time frame? And has it coiled up? Has it compressed? Has it given you an HVF? Has it done anything super interesting? Not really. So it could limp out for a bit and then get its mojo again. We hope that that wouldn't run that low, but it did. Could it be an imperfect HVF? It could be. You know, sometimes you just get a minor technical run and it's not something to be sweated about and you ignore it. I don't tend to overdo that. You start making excuses for price behavior. You're not trading what you see anymore. You're starting to trade what you wish, and you've got to avoid doing that. But broadly, you could have a flag structure like that.
It doesn't look too bad, does it?
It's not bad at all. This is close to, for the people that losing their nerves, they're too big. This is close to the high you made there and the rebound high you made there.
Yeah.
You're within a small percentage of your highs. What is your problem? And it wasn't a problem when it was down here either. We weren't panic selling out of our longs. You've got to stay with the big time frame trade. You've got to stay with the big time frame trade. As sure as you got your entries on that 20K by trading a 19.9, all the nines, you've got long there. Q should still be in this trade. And I point you back to the monthly candlesticks. This guy, and when I said 40, by the way, 40 is conservative. I actually have 42.5. The target was 40, but you know you have a very key neckline on this chart. So this is a really messy chart. It's a hard-working one. So bear with me while I make sense of it for everybody. And I've done a lot of draws. But if we go up here to daily, and I think I'm going to take you now to even the 3 daily. This is the value of key levels of significance. You have a 42,500 neckline. That blue line there, let me just grab him. I'm going to double him up to make him supersize. That's him there. Now that head and shoulders performed. It was perfect performance. And I remember people saying that will never make its target. I remember during the bull years when we were talking bearish and everybody hated on us and it's never going back down there and I'll load up the truck and I'll be doing all of these bravados, and then they were in sheer nerves when it happened. Armpit 2, armpit 1, that was the head and shoulder. That picked your bottom. It picked the bottom like a surgeon with micro glasses squeezing a capillary that is a couple of millimeters thick. That's how it picked the bottom. That's it.
It's crazy when you sort of look at it. Yeah.
That is your bottom. So don't tell me this neckline is not going to be an interesting level and a very key level. Don't tell me it running through the corner of this flag here, this flag over here that formed a long time ago is not going to be a very, very seminal level. Over here, go with Fat Koki to show you that flag. That was the flag. We called that a flag, bearish, and we were hated for that because it was not what people wanted to hear. Now we're talking bullish. We don't know if people like us anymore. We don't care. We're going to tell you what we see. That is a mother of all flags. It was a mother of all flags through, and it had a smaller one into there that gave you the right shoulder, and then down, boom. But this is all one huge pole into that. A huge, huge pole into that flag structure. It was massive. That 42.5 runs through that corner. That armpit 2, or in fact, it's the triggering event. My apologies. Let me restate that. I was inaccurate. That was your triggering event of your head and shoulder. There's the shoulder and head one more time for everybody. That was the apex corner of that flag. And that 42.5 runs diagonally through that flag. You had a final reach up with a shooting star. We called those kettle drumsticks. There's no phrase for it. We had to come up with it. A hammer followed by a shooting star. Unlike what Nissan says, he'll show you a shooting star after a period of ups, and then it's followed by a period of downs, or a hammer after a period of downs, it's a reversal to a period of ups. When you get them back to back, that is a range testing event. You first test down, you first test up before you make a substantial major move. Those two candles are absolute gifts inside a pattern that is in of itself a massive, massive gift. There they are, the two candles. Let me get it properly around there. Those two candles. And what happened? You touched your 42.5, your neckline that you had already triggered and broken there. One last time as part of the return move, you were in a bear flag. You should have jumped in short on the flag there if you weren't already short over there. And then you would have rolled, rolled, rolled. And guess what? You would have been the guy who sold the bottom of Bitcoin down there.
Yep. It's amazing, isn't it? Yeah. It's amazing. People that say technical analysis doesn't work have got no idea. You know, people have got to remember that neckline and the break of that all occurred around the Terra Luna fiasco. So that's the technicals showing you exactly what's going to happen fundamentally.
There's always the fundamental narrative, and it's not like they're mutually exclusive. It's the same coin. It's just the other side of the same coin. Technically, that's what happened. So when I told you 40.3, I actually still personally feel that you're not going to, if we get the time, the only thing that destroys this, and I have to, one minor safety margin, is if they preemptively bring forward the collapse.
Yep.
Or maybe the collapse happens and Bitcoin runs as part of the collapse. So the collapse might, you would hope to make 43.31, or in my opinion, a run through. Remember, targets aren't performed to exactly. I mean, this is ridiculous. You got a couple of bucks more, but not much. But most targets, typically you get a little bit of run through on this. So the run through I would see would be to the 42.5 is possible if you have sufficient momentum. Remember, you get a blow off. So you're covering hundreds in hours in that period. So you can overshoot, and that would be the 42.5. At that point, I'm good. I'm taking some profits. And then people go, but $1 million or 100 grand. Yes, I'll buy in cheaper later. The fact that you think it will all be in a straight line is a mistake. We don't have an HVF like the first cup gold nugget. Back then, there's going to be key levels of significance. Maybe there'll be new news. The Fed will say, well, we're thinking maybe we should ban this Bitcoin FUD. Boom, it comes back down a bit. You buy it again at 30 or 25, and then it goes 100. The point is, that will be a good technical point. You've got to decide what your time frame is. If you're a long-term believer and you think there's no way they could ever ban Bitcoin, there's no way they'll ever do anything, that you won't be able to go on grid, that the miners will be taken down, that you won't have power, that you won't do anything, then you're a full term, you may as well be hodl. It's just an outright hodl. And then you should just buy on lows. But the point is, if that's your only strategy and you're wrong, you're in trouble. You put everything on the fastest horse, and it's failed.
Yeah,
but I prefer diversification, and I prefer to take some things off at a time and see if I can do better. But I don't do it regularly. It's not like day trading or every week I'm changing position. We are a net long, and we remain a net long. This pattern triggered. Our message is clear. We're a bull, and it's the first time we've been a bull in a long time. We were calling all these bear patterns early on, way back here. That first flag break back then, that set up another one. So you're talking about 55. When you had that capitulation, we had an upside where we thought it could project to 84. The minute it ran that funnel and low in and around the 55s, we said it's not going to do it. That big candle sell-off, it rallied all the way back up to here. But after it had happened, we said, that's it. Your trend has changed. Much like I was referring to the slap in face on the 2-year yield. So, you know, we've been net bearish for a long time. People say, oh, finally you pivoted. Well, we pivoted when we said, if you get up here and you make a right shoulder, we will pivot on that to bullish. And we were starting to feel bullish during this period. We say, give us this, and that's our signal. And guys got in at 19,900. I mean, you're literally getting the second low. We also highlighted that this was very low vol, and it's typical of bottoming, and that you had that. So we were in a, you know, there could be a turning coming, but we weren't yet ready to turn. But since this has happened, we are a bull, and it remains that way. And it remains that way. How does it get undone? You run that low. It's quite simple. We always have a value where we accept we're wrong. This is not a belief system. There's a value. You know, we reverse again. We say, sorry, guys, that reversal pattern failed. It runs 19.9. We're done. Until then, everything else is just a bit of churn and news. That monthly candle, gorgeous. Best you could hope for. Keep holding. Little bit of choppiness. It's done so much from there. Don't forget, 19.9 to 28.
It's a big move, right?
$8,500 on $19,000. I'm telling you, it's a big move, 50% on gold. And you're talking about nigh on 50% move in Bitcoin in just three-day candles. You know, we're on a 3-day chart here. You got 3 candles here. One, I'll wait till it lets me draw again. It's a bit stressed. 1, 2, and 3. You did it in 9 trading days. 9 trading days. You know, we're talking about 50% on gold, and you know, taking maybe a year and a half and to happen, or maybe it'll happen quicker this time, as it took 13 months last time. Maybe it'll take 9 months and it'll be really violent and overshoot, but that's big time frame stuff. This is 3 candles, 50%. So chill out, relax. It's got to breathe. 27.5. You've got this structure here.
Yeah, you've ran into your first sort of bit of resistance. It's very thin volume that you shot through. It does very much seem like Bitcoin is set for upside. I know you've got, and I'm not sure how much you rate CME gaps.
So I want to kill that. You've provoked me now. I want to absolutely kill that.
Yeah.
No, there is no concept of CME gaps. CME gaps are an absolute myth. And the amount of people I see talking about it, it absolutely annoys me to all hell and gone. So let me just give you the parable. It's like moving averages. I have very strong views on these things, and I can justify them. Moving averages are dragging a dead cow behind you and then suddenly wondering, is the cow following you? The tow rope is mathematics. You've made him follow you. He's dead and you're dragging him behind you. That's moving averages. One of my pet peeves. My second P for crypto guys, and Brunt and many others that are big follower guys, repeated infinitum, CME gaps. Let me explain CME. They are open Monday to Friday. They started long after Bitcoin had already existed for a number of years and was trading every single day, including weekends. Bitcoin, when you have a CME gap, actually didn't gap. It was trading all along on exchanges during that period.
Okay.
You shut your business down for 2 days and decided, oh, you were there, now you're here. A gap is when there is no opportunity to trade, news events has occurred, and the market next opens, and you get a substantial zero volume at that price range that you've gapped to. So you closed at 20,000 Bitcoin, you opened at 28,000 Bitcoin, boom, like that. You had an 8,500 gap. That is a gap. On a normal exchange, that's open all the time, like a Bitfinex, a Binance, or whatever you want, or a DEX that's open all time. Everybody just suddenly, somebody said something and nobody wanted to sell their Bitcoin. And the first time someone sold their Bitcoin was for 8 grand more. That is a gap, a legit gap. Somebody who is selling hot dogs and decides not to work for 2 days and then realizes he can charge more for his hot dogs, when there were other hot dog stands open alongside him, they were trading and slowly increased their prices. I can't quit a business for 6 months and come back and say there's a gap. You chose not to be open for business, and other venues were, and it traded. So there was real volume that traded in the gap. So if you have a Friday close at 28,000 and you have a Monday open of 28,400, you didn't get a 400 gap. The idiot exchange shut and the activity continued, and they picked up on the activity later because they chose to take a holiday. Yeah, because it actually traded 2,801 on Bitfinex, 2,803, 4, 5, 6, Binance, Bitfinex, Co-op, DEX, the Uniswap, all of them, and traded. So it traded, it didn't jump. The insinuation of a gap is sudden movement with zero volume from one price point to another price point where you long jumped. You didn't walk. There were no footprints in the sand. There's no footprints on the CME because they chose to shut down on something that trades 7 days. That means they weren't open for business. Bitcoin was open for business, and Bitcoin was trading, and it traded, and it had footprints in the sand between 28,000 and 28,400, and closing a gap that didn't exist because you want to use an exchange that wants to go to sleep is a fucking stupidity.
Yeah.
And I just have to put this
bullshit
to death,
because it makes total sense.
Many misnomers and garbage that is being sprouted, and people with supposedly high credibility and all of that, and I'm trading the gap. The day and let me also say, the day the exchanges, the Chicago exchanges, represent the primary volume and the primary activity of the bulk of the players in Bitcoin, you can start talking about a dominant exchange. I still don't think you can talk about a gap if somewhere else it was able to change all the way through. It doesn't meet even the technical definition of a gap. So every That gap trading strategy is a nonsense. Change the number of days in the week and work 6 days and have 3 days off, and you're going to get different data for gaps.
Yep.
Change it from 4 days and 1 day off, you have different data. Change the number of fingers on your hand and you're going to get different garbage data, all of it garbage and meaningless. It is an absolute misnomer and foolhardiness. Bitcoin traded, Bitcoin was open for business. The Chicago pit traders and now the screen jockeys pissed off home to throw frisbee with their kids. Got nothing to do with Bitcoin. It traded.
Yeah, I think that's fascinating. I've never actually even thought to look at it like that. You know, it's null and void, really, that gap, because there was no gap. Yeah, I've never actually thought about it like that. I often have looked at gaps that take place in the stock market, and they do quite often get filled. But it's more the intent behind why that gap's taking
gaps
place.
In stock markets, there were no other places you could trade that equity. Time was allowed to elapse, and there was no volume of any kind that is accepted that occurred from the Friday close or the overnight gap. It can even be a Monday through to a Tuesday morning gap, and is usually followed as a result of news events specific to that stock or highly bullish fundamental macro events to markets as a whole. And those are the technical gaps that pit traders that used to discuss this, commodity traders and all of these people, including people like Brunt, who said he's a commodity trader for all those years, but still talks about Bitcoin gaps. The Chicago, the contract they have there is not even the primary tool. It's not even the primary volume for Bitcoin. So why is anyone even caring what it truly is? It's truly like, you all sell hot dogs, but Francis Hunt has his own hot dog stand, and he only likes to work Mondays. And he just changed the price, and he said that the price for hot dogs have gapped because I'm keeping the price and I'm making a chart called the Francis Hunt Hot Dog Index. I can't do that. Why would anyone pay any attention and say, well, the moved? You weren't available. The markets for hot dogs been, trading all this time.
It makes a lot of sense.
They're an irrelevance. When they become scale, when they use disproportionate leverage and the bulk goes through there, and retail is absolutely nothing, and there's lots of institutional engagement, you can start to say there's at least a lead steer and a bull. But you still can't say there's been a technical gap if during the weekend, other people who chose to be open and were functioning saw real pricing be affected that covered that point. You did not long jump. You did not fly in the air and not cover with zero volume all those price ranges. It traded. You chose not to take that data from other places where it traded into account, and you ignored legitimate trade. End of story, not a gap.
Yeah, it's not really a gap. It's an outage, right?
Yeah, it's the same as me pulling out the power on Binance for 25 minutes and Bitcoin's price was moving, and then declaring that Binance as the biggest exchange, which it is on Bitcoin. It's a more meaningful of me to say that there would be a gap. I wouldn't when Bitcoin jumps $15 when 25 minutes of outage on Binance, because it's actually a more significant exchange at the moment. Anyway. That's a bugbear.
No, that's fascinating. I remember asking you a similar thing about indicators, and I thought the answer that you had was fascinating, because the kind of retail technical analysis is often why people get wrecked, and it's important to
and then listen to 40-year, 50-year veterans who've written books about nothing. There's so many books I've seen that you can read, and it's all about nothing. And I can tell you they've learned nothing. And they spout and sprout and say, if it's good enough for Schumpeter and Schmo that wrote this book way back then and all of that, it's good enough for me. And those people made no money, weren't renowned hedge fund, even traders. They were book writers and academics. I get nothing but frustrated. You have to query and question everything. If something traded and there was actual volume, there is no gap. You are choosing to ignore every other exchange that actually was open when you decided to take a crap and play with your kiddies. It's garbage. So yeah, that's it. But there's so many elephants out there, white elephants, boogeymen, narratives that are getting kicked around that make people sound smart. And, oh, I remember what about the CME gap? That's pretense. There's such a scope for pretense out in anybody who thinks he wants to position himself as either an influencer and they haven't given it any thought as to what even is a definition of a gap to be able to make it. And who suddenly made the newbie exchange that doesn't even can't make up its mind if it wants Bitcoin or crypto to even exist, to be the determining factor as to whether the price gapped or not. Answer me that one as well as a separate query, why you should even be paying attention. In actual fact, you should look at the biggest decentralized exchange, which is, I don't know who it might be. It might be Uniswap or Pancake, whatever.
Yeah,
Call
Uniswap.
me. There's smarter people than me to tell you, answer that question. And you should be saying 24/7, that is your market. The central exchanges, it seems like there's an axis of attack on all of them. So they may all be declining. I mean, at one point, Bitfinex was the biggest platform. I used to use Poloniex. I don't even know if it still exists. They all traded Bitcoin at a point. What about Mt. Gox? They were early, they were all there, but they're not the volume right now. Binance is the volume. DEXs will be the volume, hopefully, of the future. We can get more people in there. I don't think you have the trading tools you need yet. I hope they come, because I don't want to use centralized exchanges. I got wrecked on one, partially as well. So we all know that we don't want to use them, but no one else is giving me what I need for what I was doing. So now I have to adjust my strategy to investment or highly spread across a lot of different smaller proxy platforms and use some, I'm even using some traditional platforms. But all those are derivatives. So here's an important point we haven't discussed that's very important for everyone to think. Everyone here who's sitting, listening to us right now and say, I'm going to get $1 million or 100 grand. I'm going to max leverage. Francis says it's a great monthly candle. I'm just going to go to the moon. Counterparty risk is huge. So first of all, position sizing, you can still within a monthly candle dip a long way back and then close all the way back up. So sizing is important. Survive that. If you can survive your money management, which is what we seek to aim and train and to remind people of in our community, then you've got half a chance. But you've got to also remember counterparty risk. And it's not going to be counterparty like one will fail. This is the period of group failure. You are in globally, or worldwide, let me rather say, a leper colony of failed nation states. Fiat is ready to fail everywhere. So everywhere banks can fail simultaneously in a short contagion period, and everywhere your derivative contract that you have on an IG trading CFDs long Bitcoin to 42.5 because you think I'm going to be right, it'll overshoot and whatever, they will renege on you. They will all renege on you. And the foundation of trading is to have that base layer on a pyramid of investment. And the investment is what saves you in contagion, and you've got to have it on you. If you own shares, I think you'll still have record of that. Download your statements proving you're buying it, save them offline so that the broker goes down. Hopefully they actually keep your script. You can prove you held it. So equities could be a bit ropey, but its counterparty risk is your biggest problem. And that's one of the reasons why I say to someone, and you are all in crypto, as Mr. All in Crypto, you are all in crypto, have some gold in your hand, because I know that can't be taken off you. Someone with a gun's got to come and punch you to take it off, and that protects you. Counterparty risk is huge. So all the trades I'm thinking of, I'm also thinking of, will the other party to this losing bet, if I'm right, as much as I'm going to be right, still be around for me to get the money I earn on it? I'm not thinking of SCME gaps, that I can tell you. I'm thinking, are they still going to be around? FTX ain't around, Mt. Gox ain't around.
You need that insurance.
Certain banks aren't around, and when they go, they're going to go the lot. And that's how they steal all your money. They say, look, guys, the whole system went, and one they went, we couldn't stop it. It was all contagion, all fall down. They've got to have it's a spontaneous demolition. You need to think, think of those 9/11 towers and how suddenly down, the whole thing went. And there wasn't, oh, thank God I was in the other tower. No, amazingly, in the leper colony, that tower fell too. And you could watch it all from World Trade 7. No, World Trade 7 too. Ooh, 5:30, bit late. It fell behind schedule. bang, 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 spontaneous collapse. There's your entire World Trade Center place reduced to rubble. There was no place to hide. If you didn't own it and you weren't standing back from it, you're done. So all your bets will fail and you won't get compensated, and every money and margin you had will be lost. So there is a real risk of that. And we put links in our YouTubes below and say, here's what I currently am using, because people always ask us. But I've got simple FX in there. They can take crypto and you can trade currencies, etc. And you can affiliate there and it's no problem. But do I know they're going to be standing next month, next year? I don't. We've got good brokers that we've met the people, but they have liquidity providers. If those liquidity providers gone, doesn't matter how good they are and how much deposit they had there. Their stuff's blown up. The whole lot's blown up. We're talking about a systemic takedown you have never seen in scale before that is incoming. That is why I keep focusing on de-digitalizing and holding in tangent. Own the house, own the solar panels, own your silver and gold. You're better off than everybody else. Then do your crypto stacking. And if you have money, spend that money on those physical things. It's the time to get physical right now. And they want you digital. And the crowding out, every small thing is a crowding out. You've had the squeeze on the smaller banks. Who got all the deposits? The big banks. Oh, how kind of them to deposit 30 billion in New Republic Bank. They've just got the better part of 65 billion coming towards them from all the small banks that Yellen, little Boba Yoda, is saying, well, we'll back the big guys, and then everything else is kind of case by case basis. Who will see? Maybe we will, maybe we won't. Oh, well, thanks very much. It's clearly who you work for and who owns the Fed. That's for sure, because you're now sending all the money. And what a perfect place. Herded all the sheep into the field next to the abattoir. Nice and easy job for good old sharing. And you've got to watch out. So counterparty risk is huge right now. We are in an economic system that is on the edge of the world, in truth. I'm expecting trading systems, losses of balances. And I've already experienced it, loss of balance. I lost a 7-digit sum on one crypto platform. So we'll see more. And, I thought he was going to be Zuckerberg for, Facebook, and that they would preserve him, a hero, the garage entrepreneur that made it all the way. We got fooled. Bad assumption. He was cleaning out a lot of things. He was probably involved in everything. Wrong. Okay, I paid for that lesson big time. But luckily I had other resources. I didn't have all my stuff there. If I'd had everything and I was all in crypto on that exchange, I would be a completely busted flush.
Yep.
And this is what I'm saying to you right now. Don't let crypto be your FTX entirely.
Yep.
Buy your home, buy your land, buy your space, buy your, your reset stuff, and you've got limited time. I wouldn't waste a day. That doesn't mean you have to panic. It's not necessary tomorrow, but you've got limited time. Use every day, achieve one thing on your reset list. Don't keep fiat in the bank beyond 3 months living expenses without any major purchases in there. If you're planning a major purchase, don't leave it in the bank. You can buy, gold and hold it for 3 months, and it's easy to liquidate gold, and the spread is narrow. You might even make something, but you shouldn't lose much if you need it. So don't let them take your stuff, because they're coming to do it. It's a hollowing out of the middle classes. This is what's coming. And so good luck to us. I hope some of the cryptos, there will be some things that will be allowed to exist and thrive, that serve their agenda, and there'll be some things that have to die, and a lot of things are coming end of cycle, and you probably got feet and hands and arms in quite a few, and you don't want them cut off. So that's my message. But Bitcoin is bull and gold is bull, and that's positive and good news. Cold storage it, put it on your whatever safety device, your brand of choice, and keep it there. You'll have some wealth, but I would also say get physical gold.
Yeah, no, I think that's a really, really powerful statement. You do need, and it's not a hard pill for me to swallow all with a channel like All in Crypto, with that being the name. It's more about safety and defense, I think, because they are planning on bringing the kibosh down. And if you're all on one side of things, you're in a world of trouble. You need that Shire horse that's going to do the work every day, which could be the likes of precious metals. You know, you need something outside of the system. Housing's an interesting one. I'm not quite convinced that buying a house in the UK means that that value is 100% safe. It's going to be interesting how they do all that. But I think that's a really powerful and genuine message that you delivered there. You know, I do think there's a window of opportunity with crypto, which you've highlighted, but it's a window. There's something coming down the line which we're looking at that, you know, they need to bring the whole house of cards down. And I think this is when they do it. So Francis, I know I've taken quite a bit of your time. It's always an absolute pleasure to have you on the show. We've gone over so much there, from the debt markets to crypto, and also really spoke about how you can prepare for what's on the horizon. It's been an absolute pleasure, Francis. Do you want to tell people where they can find you? As always, we'll leave links to where they can find you in the description. I am now a member of the HVF community, and I'm having a brilliant time, but I'm sure we can maybe talk about that at another point.
Yes, so just on the housing comment, just to finish, I don't think housing is going to do well. I'm talking about make sure you have your own home to live in to see this through, so that you can't be thrown out or bullied too much. I'm expecting a lot of extraction on property, a lot of blockchain, forced blockchain enrollment to register property. I'm expecting BlackRock to do immense amounts of purchases of people's homes that are over leveraged. So there's a lot going on. It's not as an asset class, I'm saying good, go and get it. It's more just a case of make sure you are set for hunkering down for food property. That was the key point. So I actually quite bearish property, and particularly in the UK as well. So when banks go down, lending goes down, values go down, there'll be forced sellers and there'll be bottom pickers. Maybe you can bottom pick if you're not already in the market, but you'll know the environment and you're going to have to preserve your money until then. But we are focused. We are fully focused on finding big R trades, real rewards to tight risk management. So we are 3 R's, risk reward ratio. You will study the course materials, 3 R's, HVF method, hunt volatility funnel, revealed, refined, and rewarded. They 3 R's for a reason, because we are risk reward ratio orientated traders that trade really low risk to high movement, big macro movements. We use multiple time frames. So we use smaller patterns to break into medium-sized ones that are all part of a much bigger supernova pattern where you can get a macro move. That is how you accumulate big R's on tight risk. So that's our focus. And we build wealth, and we help people also with structures who, once you have wealth and you have things to protect, and you need to do that before the wealth is lost, not after. And there is still time. As much as everything is really building up to a crescendo, you always have more time than you realize. And doing positive things to protect yourself every day is absolute mental fortitude, keeps you de-stressed, keeps you focused, keeps you positive, and keeps you optimistic in an external environment that is pretty dark. There's a lot of light within. There's a lot of light within our community with people like yourself in our community as well, that are continuing seizing the opportunities and sharing their knowledge. Go to themarketsniper.com. Simple. Book a call. It could be the pivot in your life for building wealth. And I'm telling you, there's a polarization coming. Those that are prepared and have built wealth, and those that haven't. Counterparty risk is something to be watched. We can't tell you where it's going to blow up. We suspect everywhere, potentially, but we're continuing to try find the safest ways. And you'll love being part of a community, lots of bright minds in both reset, crypto, and of course the macro markets. You'll find all of it covered there. Amazing webinars and content. Thank you for letting me come on, and book a call at themarketsniper.com or follow the YouTube channel.
Yep. Fail to plan, plan to fail. Francis, it's been an absolute pleasure as always. Thank you very much.